Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. So interest rates are at all-time lows. Some people are suggesting that because of that, too many people are borrowing huge amounts of money to invest in the stock market and the real estate market, that the real estate market may be overblown, overvalued, and that we're heading for a crash. That said, until such time as that happens, you know what? You've never had it better as far as borrowing money in a mortgage from an interest rate. So I wanted to reach out to someone that's just recently joined the mortgage lending business. Natasha Sokolovski is a recent mortgage broker. She spent 10 years with the government in different functions. And during COVID, she sort of had to decide what she wanted to do in life. And she decided that what she wanted to do was get involved in the real estate market. And she took a bunch of courses and became a mortgage lending specialist and joined Dominion Lending Centers in a managing position, managing mortgages. Natasha, how are you? Welcome to our show.
I'm good. Thank you. Thank you for having me, Brian.
So what do you think? Is our interest rates at an all-time low? Is this the best time in history to raise money, or are we set for a problem?
You know what? I have to say, I think interest rates have definitely bottomed out and they are at an all-time low. And it's the perfect opportunity for people who are looking to purchase properties or even refinance to take on mortgage debt. Definitely. It's the most opportune time to leverage that debt in order to set themselves up for financial freedom later on in life.
So because Natasha obviously is expert on this business, she sent me a chart that I want to share with everyone right now because it really sets the scene. And maybe, Natasha, you can tell us a little bit about this chart and what you think it means.
All right. So this chart right here is actually the Bank of Canada overnight rate. And this is the rate that's utilized for the variable rates. And I know there's a lot of debates going on right now in the market as to whether or not someone should take a variable rate or should they take a fixed rate. And my positioning is that the variable rate product is definitely the product to take. And if you look at this chart, you can kind of see here that from 1935 to 1970, it took 35 years for the interest rate to increase from 2.5% to 7.5%. So really, it took 35 years for the interest rate to go up by 5%, which is huge. And I think right now, because the rates are so low, there's a lot of speculation happening that, okay, the rates are going to skyrocket. They're going to go up. They're going to increase to an exorbitant amount. But really, when you look at the stats, they're not. We're not going to have these skyrocketed rates that people are anticipating. So having the prime rate right now at 2.45%, it's probably going to hover around that amount for the next couple of years. And when you factor that in, you would save an exorbitant amount of money by sticking with the variable rate right from the get-go, because the majority of your payments are going to go towards the principal versus interest.
So now's the time to borrow. Now's the time to borrow short-term with a variable rate and maximize your debt repayment by putting all the money that you have to pay for your mortgage to your principal payment. Get that debt down as quickly as possible.
Exactly. Well, and it's up to you, because it's interesting, because I know for my generations, like I'm part of the millennial generation. We have this mindset that, you know, why pay off our mortgage? Like, why should we pay it off completely? When the term ends and it comes time to refinance, we're all looking to pull that equity out and reinvest it elsewhere. I think the whole mindset of paying off your mortgage is just prior generations. I know that was part of my parents' generation and the prior generations. And then you just have these young millennials that are just willing to take on so much risk and really utilize their debt to just continue to either reinvest into the stock market, or now you have cryptocurrency that's really exploding, or into other properties.
Well, we'll come back in a minute after some message breaks as to whether that's smart or not. But you heard it here from Natasha. Invest maximum leverage and take your money off the table and invest it in the stock market. Sounds like a pretty risky strategy to me, but who knows? Maybe it works. We're going to take a break for some messages and come back more with Natasha, a mortgage lending broker with Dominion Lending Centers, in just a minute. Stay with us. Welcome back to the Brian Crombie Radio, while we're on Second and 60. We're chatting tonight with Natasha Sokolovski, who is a mortgage lender with Dominion Lending Centers. She's joined that recently after a 10-year career with the public sector over different lines of business. She is a driven leader, she says, and she's driven and motivated to help people. Like everyone else in the world, she's had some setbacks during COVID. She had to think about what she wanted to do in life, and she decided that what she wanted to do was help people with their financial health and their homes. And so she took some courses and became a licensed mortgage broker, and now works, as we mentioned, for Dominion Lending Centers. Some people are worried about inflation. Debt is all-time high. Supposedly, we grew as much debt in the last 2 years as we've had in history up until then. And when you increase government debt dramatically, at some point in time, you got to pay it back. And when you pay it back, typically inflation goes up. If inflation goes up, that would suggest interest rates are going to go. What do you think, Natasha? Are you worried about inflation?
Well, you see that the inflation rate right now is at about 4.1%. That's what was posted back in August from Statistics Canada. And so, yes, inflation directly correlates with the mortgage rate. The 5-year bond yield is linked to fixed mortgages. And so because inflation has been up, the 5-year bond yield rate went up on Friday. It actually went up to 1.7%. And so in the past month, it's gone up 34%. And you're starting to see that the fixed mortgage rates are starting to increase. I know when I last checked the rates, CIBC, their uninsured 5-year fixed rate went from 2.24% to 2.36. Their insured 5-year fixed rate went from 1.99 to 2.19. So you're starting to see an increase, and that's not surprising. And at the same token, you also have to look at consumers, because if you're fearful of inflation, that's going to also change the way that you spend money, the way that you invest your money, the way that you save your money. I know with inflation right now, we're in a weird time, because you also have to factor in what's happening with the labor market. There's a shortage of work right now. A lot of businesses are really struggling to hire on people. There's a lot of vacancies. And you also see that there's 1.7 million Canadians on a wage subsidy program, which is huge. And that's anticipated to expire on October 23rd. So you have a lot of moving parts at play that we really don't know how things are going to play out. And I think with COVID, I'm sure all of us can agree, the only thing that I'm sure we've all learned about COVID is that the only certainty in life is uncertainty. And I wish I had a crystal ball to kind of dictate how things would unfold, but I really don't know how things are going to unfold. I can only just speculate with my own opinions, but I do think inflation is definitely going to potentially increase. I know there's a lot of articles being posted right now stating that it's transitory, and that once the whole supply chain aspect of things kind of eases up, gas prices come down, they're anticipating that inflation is just going to go down. My opinion, I don't personally see that happening because of all the factors that are going into play. And then who knows, especially if we have a fourth wave with COVID. So fixed rates, for sure, I think are going to consistently go up, which just allows me to argue more as to why we should, if you're looking to purchase or refinance, stick to a variable rate right now.
Okay, but variable rates over time should equal the fixed rate. Like if fixed rates are going up, that's what the market's best guess is what short-term rates are going to be in the future. And so therefore, doesn't that argue for, and frankly, you should, if your fixed rate is 4.5% or something like that, for it to average out, short-term rates in the future have got to be greater than the 4.5. So it's on average back to that 4.5% rate. So isn't all those players, all those arbitrageurs, all those financiers in the marketplace, effectively telling people that the short-term interest rates are going up and they're going to go up to 4.5% to equal the fixed rate, if not, frankly, above that. So it averages out to the fixed rate.
Well, I know, well, that's interesting because I know with the Bank of Canada, they were pretty committed at holding the interest rate to kind of where it is right now until they saw inflation come down to 2%. Like they have 8 scheduled meetings a year. Their next meeting is supposed to happen around October 27. So it'll be really interesting to see the position that they take. But if they're being committed to not really making significant changes until inflation comes down, then one could easily argue that variable would be the way to go because their rates would essentially kind of pivot around, will hover around the same amount.
So some people think that one of the reasons why inflation is high right now is because of your point that a lot of people are on social assistance, government, subsidies, wage subsidies programs because of COVID-19. And that when that ends at the end of October, assuming that it's not extended, because it could easily be extended, particularly if we enter into a fourth wave. But if it ends, that there's going to be a lot of people looking for work because they're no longer going to be paid to stay at home. And when they start looking for work, that labor market that you describe as being tight, which it is going to open up. There's going to be a lot more people that are looking for jobs, and inflation, wage inflation at least, will come down. What do you think of that?
I think it'll be really interesting to see what happens. A part of me almost feels as if it's going to be extended. I think with the government not knowing what's going to happen with COVID and the potential fourth wave, and you saw it with CERB and then a transition to CRB, it seems that like they just keep coming out with different benefit programs that I don't think it's going to end at that time. I think they're going to continue on and maybe even just call it another benefit name.
Call it another benefit name. Okay.
So easy on us.
So right now, the debt that we have on households in Canada to income is at an all-time high. And if you look at debt to house values to rent, we're also at an all-time high. And we all know it. It was one of the issues in the leaders' debate during the political campaigns. Home affordability, housing is at an incredible high, particularly in major metropolitan areas like the Greater Toronto Area, Vancouver, Montreal, etc. But even in suburbia, where a lot of people moved out of the downtown core and bought homes in suburbia, and lots of people have been saying we're set for a bubble burst, and yet it hasn't happened as of yet. What do you think? Is the real estate market at risk for a burst?
I would say it's inevitable. Like I don't think these prices are going to remain where they're at. So I do think, with real estate, it's at all-time highs right now. I know even for myself, when I bought my investment property this year, it's a weird landscape to be bidding on properties where if you don't even go in at your best offer, you don't even get an opportunity to counter. There's no negotiations happening in that type of market. Like, it's just not sustainable. Those who are able to sell right now and really capitalize on the equity that they build in their homes, it's great. But like anything in life, there's always cycles. What goes up must come down. And we're going to start to see that with the real estate market as well. It's not going to remain at these all-time highs. I think it will come down a bit. I think right now, when it comes to supply and demand, there's not a lot of supply out there right now. And I think that's what's really driving the prices to remain at highs. But I think over the course of the next couple of years, it will start to level out. But then you're going to have to deal with the alternative. Once housing prices come down a bit, you're going to start to see the opposite. Interest rates are going to be going up.
So if housing prices are coming down and you think interest rates will be going up, is this the right time to leverage up? Or is this the right time to stay conservative and not leverage up?
I would say definitely this is the time to leverage up, because I think regardless of the way that the cycles work, if you start to average out how much equity that you're able to generate year over year, you're still getting ahead. The earlier you get into the real estate market, the better off you are. So if you are able to purchase right now, you'll definitely benefit in the long run.
So real estate over the course of the last 50 years in Canada, or the Greater Toronto Area at least, has grown at twice the rate of inflation. And in the last little while, some people are talking about 15 to 20% growth, which would be like 5 times the rate of inflation. So you think get in early is the solution for millennials and anybody else?
Get in early. Get in early. Build that equity. Build it so that you can reinvest elsewhere. I just think, you start to see it too with the whole labor market. I know, like back in the day, people typically only had one job, and now you see people wearing so many different hats. And I think there's so much importance placed on generating different areas of wealth. And you can only do so much when it comes to generating wealth by having a job. You really want to ensure that you want your money to work for itself. So it's really great to seek opportunities, different investment opportunities, so you can compound your money and make it in a passive manner.
Okay, so you've taken this mortgage license course, and you're now a licensed mortgage broker. The government has and the CMHC have changed stress tests on mortgages recently, and they're using that to try to calm down the market. Explain that, the change in stress tests to us, if you could. What's the implication of that?
So on June 1st, they increased the stress test to either 5.25% or an increase of 2%, the greater of the two. And the whole rationale was to ensure that, one, you're able to afford the mortgage at those rates, should rates increase over the term of your mortgage. And two, it was a mechanism to try and help the affordability issue with the housing market. I would say the increase didn't really impact the affordability of housing, because housing is still expensive, but it's also, I would say, a really good practice to ensure that people can afford their mortgages during the term should interest rates do go up to that level. So I think as a security piece, it's just great in terms of really ensuring that our housing market is as safe and as secure as possible.
So what it's effectively done is lower the amount of debt that someone can put against the house, has it not?
It has. So I think if you were to, the increase when you work it out number wise is that you could borrow for every $100,000, you would just be able to borrow $5,000 less. So it does somewhat limit your purchasing power. Yes.
But if it hasn't calmed the market, the price market at all, then what's happened? What have people done with that $5,000 per $100,000 of price, which, is $100,000 on $1 million home? No, that's not right. $50,000 on $1 million home. What do? Do they end up putting in more equity, or are they going out and getting a second mortgage from an alternative mortgage lender?
You know what I would say when it comes to a lot of purchases, you're seeing first-time home buyers, a lot of times are getting a good portion of their down payment from gifts. So not a lot of it is coming from the individuals themselves. And then when it comes to people who are, selling their prior home and purchasing another home, it's just really them pulling out the equity in order to be able to afford these prices. Or you can even argue that location, right? They could be just going to areas where it's a bit more cost effective for what they're getting.
So I think you're right that people have moved a little bit farther afield, farther away from downtown Toronto, so they can actually afford the home. But I think you're right. Probably what's ended up happening is people have ended up going to mom and dad and other people to get the differential. So their effective equity has increased, albeit not from themselves, but from gifts from the older generations. But I also think, and I think statistics bear it out, that we're at an all-time high of second mortgages and third mortgages, that a lot of people are sort of filling in that gap that's been created by high prices and lower first mortgage availability, with even higher interest cost, riskier second and third mortgages.
Or you're even seeing people being more creative with the mortgage products that they're getting. A lot of times they're looking at getting a mortgage, but then also getting a secured line of equity that they just have to have for a rainy day. And it's almost as if people are trying to qualify for as much debt as possible, but not necessarily wanting to utilize it all at once. just having that available to them, just so that they have more options available to them later on, should anything happen, is kind of the frame of mind that people are choosing.
But an equity line of credit is not always available. It's something that the bank can claim back, is it not?
Yes.
So it's not as secure as having cash in the bank account.
Yeah. Very true.
But I think you're right that, companies as well, during tough times, it's basic finance 101 that people will go out and maximize their credit lines, husband cash, put it on the balance sheet or put it in their bank account and make sure that it's there for a rainy day. So it's a good strategy to make sure that you've got maximum availability of access to cash, particularly in tough times.
Exactly.
Okay, so interest rates are low. Particularly the variable interest rates. Your argument showing the graph that you showed us of interest rates since 1930, you think that even if they go up, they're not going to go up quickly. That's going to take, you use the example of 30 years that it took to go up to even above 7% the first time in this past century and a half, I guess. And so therefore, you would argue leverage up to the maximum you can, get into the real estate market early. Borrow as much money as you can, borrow it at short-term interest rates. But then are you saying pay down the debt as quickly as possible, or don't pay down the debt as quickly as possible?
So what I also think is interesting when it comes to mortgages, I find when I talk to clients, everyone is just really hung up on the interest rate. They always want to know what the interest rate is. But when you look at a mortgage product, there's so much more that goes into it. And you also have to look at, okay, what are the cancellation fees? What are my prepayment privileges? And so if you were to compare, taking a variable mortgage and what your payments were versus a fixed rate mortgage, being a higher interest rate, but you always know what those payments are. You as a homeowner, you can get a variable mortgage and capitalize on your prepayment privileges. A lot of lenders out there allow you to increase your payment by 20%, for instance. And so if your mortgage payment biweekly on a variable was about $1,000 every 2 weeks, and you took advantage of that 20% prepayment privilege, so that's you adding $200 every 2 weeks onto your mortgage payment, which, in the grand scheme of things, like $200, just don't go for dinner as often. You can make it happen, make those sacrifices. In the long term, you're going to be saving a significant amount of money. Like we're talking probably close to $20,000 in interest over an amortization of 25 years. And well, actually, no, I'm lying. Because if you were to amortize over 25 years, you're going to be paying off your mortgage sooner. So instead of 25 years, you're going to be paying it off in 22 years, therefore saving about $20,000 in interest. So sometimes it's also looking at the different products and what's included in those products and how can you leverage those availabilities in order for you as a person to save yourself more money. Because the more money that you have going towards principal versus interest, you're generating more wealth, right? You're having more equity in your home that you can access later on in life to do whatever you please.
So pay down the principal as quickly as possible.
Yeah, pay it down as quickly as possible. But then when your term comes up for renewal, pull that equity out and reinvest it elsewhere.
Reinvest in another. And you said that you've invested in investment property. So not only in a home that you live in, but go out and invest in a condominium and rent it to someone else or something like that. Is that what you would recommend?
Exactly. 100%.
And is that something that you think that young millennials should be doing?
You're starting to definitely see it. Like I see that there's a big shift when it comes to millennials in that I know right now, I would say about 70% of the mortgages that are being taken out are on fixed. So there's still this heavy mindset of people wanting those payments to always be the same for the entire duration of term, not so inclined to risk. But then when it comes to millennials, you're starting to see that they're really uptaking the variable rate. Like right now, there's about 21% of people that have a variable rate. And of that, majority is the millennial generation. And so who knows what the landscape is going to look like over the next coming years with the younger generation starting to infiltrate the real estate market. But you see it. You see the younger generations, we want options. You see these apps, you know, you go on Uber Eats, you want one app that gives you a whole variety of things to look into. It's the same thing when it comes to mortgages. You're having the millennials access mortgage agents now versus going into their banking institution and getting a mortgage from them. I know my parents did that. That was like the norm back then, where you get a mortgage from who you do your finances with. Whereas now the millennials are just, they have this mindset. No, like I can't just go to one bank. I have to see what other 1,000 products are available. And so they're utilizing mortgage agents more, which I think is really beautiful. This one-stop shop mentality is really, I would say, great, because there's so many products out there. I don't think people realize that you go into a bank and they only have 8 to 10 products. Whereas with mortgage agents, they have access to over 50 lenders. We're talking like over 500 products. It's a lot.
Okay, well, we're going to take a break for some messages and come back more with Natasha Sokolovski of Dominion Lending Centers in just a minute. And I'm going to ask her, what's the benefit of going to a mortgage broker versus going to your corner bank with the bank manager that you've known and worked with for a long period of time. Stay with us, everybody. Welcome back to the Brian Crombie Radio Hour on Second and 60. We're chatting tonight about interest rates and mortgages and buying a home with Natasha Sokolovski, who is a mortgage lending specialist with Dominion Lending Centers. Natasha, just before the break, you were saying that more and more people are going to mortgage brokers, lending specialists for advice on what to finance their homes with, rather than going to their bank manager or their local bank branch. Why is that, and what's the benefit of it?
So I would say a lot of people are going to mortgage agents now for, I already alluded to it, one-stop shop. It's just so much easier to work with one person who has access to a variety of different lenders and products. You as a client, you don't have to take time out of your day to go to a bank and have to perhaps take time off of work. It's just, I would say with the mortgage industry right now and how we've pivoted with COVID, a lot of the work that we're doing in terms of brokering mortgages is happening remotely. So you can call your mortgage, in the evenings, on weekends. Really, we work around your schedule to really help and accommodate your needs. So I would say in that aspect, one-stop shop, ease of access. And then at the same token, you're receiving independent financial advice. We're not tied to a specific lender. And on top of that, the way that I look at things is that it's a win-win for clients, because for the most part, there's really no charge to the clients. A lot of times, I would say for most A lenders, a lot of our broker fees are covered by the lender. So it's not a charge to the client. So there's really no downside to working with an agent, because on the plus side, you could be saving thousands of dollars by working with an agent. And worst case scenario, really, you just got free mortgage advice. You're not obligated to move forward. So the fees that you would make on providing that advice are typically paid for by the mortgage lender, not by the client. Exactly. Really? In most cases, yes. And so if I went to TD or Bank of Montreal or RBC and got a mortgage quote from them, you'd be able to get the same quote. But you'd be able to shop amongst all of them to find out what was the best rate, versus me just getting the one from that one bank branch that I went to. Exactly. And you also have to think too, when it comes to mortgage agents, there's a lot of volume in the transactions that we're doing. So even when it comes to A lenders, we have access to more competitive rates with A lenders than the average person going into a bank looking for a great mortgage product. And then the information that you require, is it the same information the bank's going to require, or less, or what? Do I have to be comfortable that the confidential information about my income and everything else that I'm going to be sharing with the bank, I'm going to be sharing with you? Exactly. Yes. So it's the same amount of information. There's no difference. The mortgage agent is going to have to pull your credit bureau, and we're going to have you fill out an application and obtain a lot of supporting documents. I think all of us who have gone through the mortgage process know there's a lot of documents entailed. But the beautiful part is you have a person just walking you through the whole process. And at Dominion Lending, the great thing about this mortgage company is that they have a portal system where clients can just upload their documents directly onto it. So if people are not comfortable with the security of utilizing email to send off their confidential documents, they can just upload it onto the portal. And at least you know it's a secure way, an easy way to transmit documents.
How'd you get in the business?
So it's actually really interesting. I still work for the city of Toronto. I still have my government job, but I actually worked for Children's Services for 6 years, specifically in that division. And I was in a management capacity for about 3 years. And they ended up ending my acting assignment. It's very common in the public sector when you're in a supervisory role. If you're not permanent, anything could happen really with your position. So in the summer months, my position had ended. And I think with COVID, it really impacted me. I think we all want this level of certainty in our lives. And when something happens that's so unexpected, it's hard. And so, I was really down. I didn't know what I wanted to do, but I had two options. Two options were really happening in my head. Either I play the victim card or I pivot. And I just decided to pivot. And someone came into my life who works in the mortgage industry, who's very successful, and just said, hey, why don't you just become a mortgage agent? And I think the beautiful part is when one door closes, another one opens. And so I decided to become a mortgage agent. And I ended up switching my careers in the public sector. And now I manage bylaw enforcement officers. And I do not have a background in enforcement. So it's been a really interesting time in my life, basically embarking on two new careers. But I have to say, looking back, I was going through a hard time, but now I'm going through a time where it's just like, wow, I'm so happy that happened to me because I'm really happy with where I'm at in life.
Awesome. Do you have a financial background or a business background?
So I actually don't have a financial background. I would say I'm an avid learner. I would label myself as a bona fide nerd. And I was always really interested in the stock market and cryptocurrency. And I probably read Bloomberg News every day. I'm just this type of person that I just love absorbing information. And so even when it came to me purchasing my own properties, when I was going through the process, it was interesting how, from a systems point of view, I was just thinking in the back of my head, if I was a mortgage agent, I would do this differently. I would do this. And then now fast forward, I became one, which is kind of crazy how life works.
Fantastic. And how do you advertise your services? How do you get clients?
So mostly through social media. So I do advertise through Facebook, Instagram, and I'm going to just be utilizing my social media platforms to be generating a bit more business. So if anyone is interested in a mortgage, feel free to add me on Instagram. My Instagram is natnatasha2.
Nat Natasha 2.
Yes.
Why Nat Natasha 2?
You know what? I've always had this Instagram handle, and I think the interesting part is that a lot of people tend to change their Instagram handles to coincide with the business that they're in. But I really just want to create more of a personal brand identity where people feel like they know me as a person. And then as a result, they feel like they can trust me. They have a relationship with me, and hopefully in turn, they would want to do business with me.
Awesome. The government has got a bunch of plans to try to cool down the real estate market. One of them is taxing capital gains. Do you think that'll happen?
I certainly hope not for my own self-interest. And I think a lot of people that I know, have that same feeling. I think, when it comes to the votership, 65% of people own homes. And I would say it'd be really interesting if it does happen, because Canada remains only, like, I would say, yeah, Canada is probably only one of the countries out there right now that doesn't tax capital gains on primary residences. So it really makes the Canadian real estate market very attractive, but at the same token, a very dependable retirement savings fund. So I think if they were to do that, those who are probably ready to retire, you're going to see them offload. Everyone's going to be selling their houses, avoiding having to pay the government, and everyone who's going to be in a position of wanting to retire is just going to end up renting. And then you're going to have the younger generations like myself who are really going to think about where their primary residence is and probably stay there. I think if anything, you're going to start to see the home improvement sector start booming, because people are just going to stay put and they're just going to start sinking in money into their primary homes and just renovating. You're not going to start to see, I don't think at least, a lot of mobility in terms of where people choose to live. So it'll be interesting. I definitely think it will slow down housing construction. I really hope it just doesn't happen. So let's all keep our fingers crossed, because I think with anything that the government has introduced, they implemented the foreign tax buyer in Ontario, and then now also the stress test, with hopes of, really making housing affordable. And those two programs didn't really impact affordability. So I'm
explain this foreign buyer tax to us.
Well, when it comes to foreign buyers that are not permanent residences in Canada, they have to pay a tax when they purchase a home in Canada.
And how much is the tax?
I believe it's around 15 to 20%, but I'm not 100% sure. So I don't want to mislead people on that number.
Okay. And you don't think it's helped to cool the market at all?
I wouldn't say so. The market
in Vancouver, they've also put in, and some people are talking about it potentially here, a vacant home tax, such that if you buy a home, you can't leave it vacant. You got to actually live in it or rent it out. Do you think that's a good idea?
Yeah, I definitely think that's a good idea, because then it's going to help with people gaining access to more affordable housing. So I definitely think it's a good idea. Like, I know with the city of Toronto, they had the vacancy tax rebate, where people who had properties that were vacant got a tax rebate. I don't think we should be offering rebates to vacant buildings or land. I think, we should be promoting the usage of putting people in there, because it's not easy, especially in a major city, to access housing. I think even with the affordable housing, it's like a 10 or 15-year waiting list. It's absolutely ridiculous.
So if people want to access your advice, maybe get you to get a mortgage for them, how do they do that?
So they can either send me an email, or they can just add me onto social media. So Instagram, Natasha 2, or they can even add me on Facebook. And my Facebook is a little weird. It's Tash Q, Tash and then QUE.
Tash Q on Facebook and Natasha 2 on Instagram.
Yes.
And do you want to give us your email or not?
Yes, definitely. It's long. My last name is not the most easiest to pronounce, but it's Sokolovski Natasha. So SOKOLOVSKI Natasha @gmail.com. Awesome.
We're chatting with Natasha Sokolovski of Dominion Lending Centers about mortgage, interest, debt, housing, and what to do about it all. We're going to take a final break and come back with some concluding comments in just a minute. Stay with us, everybody. Welcome back to the Brian Crombie Radio Hour on Saga 960. We've been talking with Natasha Sokolovski of Dominion Lending Centers about what to do with homes and debt and mortgages and interest rates, et cetera. And I guess, I'll give you my own opinion, and we'll see what Natasha has to say about my opinion. I think that the housing market is overvalued. I think that there is a risk of a potential bubble burst at some point in time. I think the government's going to try hard to manage it such that the bubble is never burst, but maybe it slows down and becomes more affordable. The challenge that governments have got is that more affordable housing, which may be attractive to younger people that want to buy homes, is unattractive to older people because they're going to lose some of the value in the equity that they've built up over life. And so therefore, you don't want to, piss off a whole older generation that are going to lose money at the same time as you're trying to make it more affordable for younger people to get into the housing market. So I think it's a challenge. I think that the number of immigrants that are coming to Canada, and it's going to be 350 to 400,000 a year, is going to be a fuel to the housing market and housing demand. And I really think that the biggest risk we've got, the biggest problem we've got with housing in Canada is, frankly, municipal governments that aren't approving home building as quickly as possible, aren't increasing the zoning to where the official plans or the places to grow legislation would be. They're not increasing the density. They're not giving building permits. It takes such a long time to get any kind of land that you're trying to develop to the market that really is impacting supply. So I think the solution to housing prices isn't necessarily government action on a foreign home buyer's tax or a restriction on vacant land or capital gains tax. It is increasing the supply, which is within government control by approving more housing. So that's number one. Number two, I do think that taxes are going to have to go up to pay for the debt that we've incurred over the course of the last couple of years. I think that inflation always goes up when the economy is booming, and the economy is doing well right now. And I think interest rates are going to go up. And so therefore, it may be prudent to think about going long-term or a fixed rate. That said, if you've got number one, Bloomberg or access to a computer, and you're checking what interest rates are doing, or you've got a mortgage broker like Natasha that can watch for you, it does make sense to go short for a while to get those variable interest rates. But really think about what you would pay if you were paying the higher rate. Pay that higher rate, and the differential in what you're saving, pay down the debt. And if you pay down the debt, you're effectively insuring yourself to a certain extent anyway. And then just watch. And if interest rates go up a lot, get Natasha or someone like her to fix your rate then. So, get pre-approved for a mortgage and watch the interest rate, stay variable, stay short-term for a while, and then go long-term if rates start to skyrocket. And I don't think they're going to skyrocket, but I do think they're going to go up. And so therefore, take a couple of years, pay down as much principal as you can, and go for the interest rates, go for the short-term interest rates now. What Natasha said, which I think is really critically important, is right now, until and unless capital gains tax on principal residences are increased, the most tax efficient, tax advantaged investment you can make is your own principal residence. And the benefit is you live in it. And so hopefully you enjoy it. And so therefore, I do agree with Natasha, get in early, buy the biggest home that you can afford, because you can maximize, therefore, your equity growth and the capital gain. Leverage it up, pay it down as quickly as possible, and do it again. Because over time, people that have invested in real estate, and real estate has grown on average at twice the rate of inflation, have done well. And if you can enjoy that at the same time as you pay down your principal, you leverage up with cheaper debt. Your actual return, which is now tax-free if it's a principal residence, is very attractive. And so that would be my recommendation. And just to give you a sense, let's say you bought $1 million home, and Natasha, you could leverage 80% of that?
Yeah.
So 80% of it, 800,000 is at what? 4%, 3%?
Depending on what? Are we talking variable or fixed?
Variable.
Variable, I think it's at 1.64.
Okay, so let's say it's 2%. So 1% of 800,000 would be 80,000. 2% would be 160,000. No, that's 20%. So we're talking about 16,000 a year. You're paying $16,000 a year. And if your fixed rate would be 4.5, 5?
Right now, you're talking, they've gone up probably say close to 3 right now.
Okay.
Perfect.
So let's say your interest rate is 16, and you take another 16 or even more, and you use that to pay down your principal. You're going to be taking your principal down fairly quickly, $20,000 a year, maybe more over time. Your leveraged return, if inflation is going up, If inflation's going up at 2 to 3 to 4%, and real estate's going up at 5 to 6 to 7% on $1 million home, that is an increase every year. That's half of your interest.
Mm-hmm.
And so you're making money on the $1 million when you only invested the 200,000 of equity. And so your return, if it's a 5 or a 10%, let's just for argument's sake, it's a 10% increase. So it's a $10,000, it's a $100,000 increase on your $1 million mortgage. That's a 50% return on your equity. If it's a 5% return, that's a 25% return on your equity, tax-free. You can't get that in any other kind of investment in the marketplace. And so that would be my recommendation. I think Natasha's described it well. Get in early, maximize your house, maximize your leverage, go short, but watch it carefully because you want to go long if interest rates skyrocket, pay down your debt, and maximize your capital gains tax-free principal residence investment. What do you think, Natasha? Good advice or not?
Oh, completely. And remember, everyone, life is variable. So your mortgage should be too, right? Like you got to think long term. You can't really think short term because anything could happen. And if COVID has taught us anything, you never know what's going to happen with regards to your jobs, your health, just anything. So it's just really important whenever you make decisions, don't be so focused on the short term. Really think long term.
Natasha Sokolovski, Dunya Lending Centers, thank you so much for joining us. Remind us again, if people want to check out your services, maybe access your mortgages, how do they do that?
So they can contact me via social media. So please reach out to me on Instagram at natnatasha2, or you can even add me on Facebook, befriend me on Facebook. And my Facebook name is Tash Q, Q-U-E.
Tash Q, Natasha Sokolovski. Thanks so much for joining us. Really appreciate it. That's our show for tonight. I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at saga960am.ca. You can get all my podcasts and videocasts at briancrombie.com. My videos are available on YouTube, Facebook, Instagram, LinkedIn, and my podcasts are available on Audible, on Apple Podcasts, on Speakeasy. Listen in. I try to educate you on what's going on in the world. Natasha, thanks so much.
Thank you.
Everybody.